Three-day losing streak on the S&P 500 about to become 4 based on this. We're down by 0.7% on the S&P. On the Nasdaq, we're down 1 full percentage point going into the opening bow after the biggest three-day slide on the Nasdaq 100 going all the way back to February, and poised now for a third week of losses on the Nasdaq, the longest losing streak on a weekly basis on the year so far. Let's your opening bow, switch on the board and get to the bond market. The epicenter of the equity pain has been in treasuries. Yields are just a little bit lower this morning to 426.84. Over the previous 6 days, though, up every single day, and up over those 6 days for a gain of more than 20 basis points. On a 10-year this morning, 426.84 after the highest closing yield going back to 07 on 10s and going back to 2011 on a 30-year. In the FX market, the dollar showing a bit of strength, the euro some weakness, 108.59 going into the ECB on September 14th. Who knows what the Fed's going to do? I've got no idea what the ECB does from here, with a soft backdrop for growth and stubbornly high inflation. 108.59 on euro dollar. Into the commodity market, crude positive here by 0.5%, $80 and about 75 cents. About 50 seconds into this one, fourth day of losses on the S&P. We're down 0.7%, down about 1 full percentage point on the Nasdaq. The one stock to watch at the open is this one. It's Deere, the company raising its annual profit outlook with demand remaining strong. The CEO saying this: fundamentals are expected to continue fueling solid demand, supported by a strong advance order position. Abby has more. Morning, Abby.
Hey, John. Well, this morning we were looking at the worst day, or moments ago at least, for Deere since early April. Now it's the end of July, but investors clearly not looking at that demand or the big beat that they produced. In fact, numbers really stellar for this company. They put up $10.20 in 1 quarter in adjusted earnings. That beat the estimate by 25%. That is a monster beat on $14.3 billion of revenue, a 1.2% beat. So a very strong quarter. They also raised the outlook, net income, but Oppenheimer is saying that guidance from Deere implies a more muted fourth quarter, and this has to do with some analysts thinking that we've seen peak agriculture, that the best is really kind of here for Deere in terms of the Russia-Ukraine war, that sent crop tire and U.S. farmers scrambling to buy their machinery. Well, something to keep in mind now, John, we do have some of the grains down sharply. In fact, wheat this year down more than 20%, its worst year since 2008. Perhaps supporting this idea that we have seen peak ag on the year. Deere is now down about 3% or so, underperforming the S&P 500 dramatically.
It's down 2% this morning. Abby, thanks for that. This one just dropped in my inbox from Bank of America. The title of it from Mike Gapen and the team: it's a scorcher. Here are the bullet points of it. This week's data flow was red hot. He pointed to July retail sales, industrial production coming in well above expectations, pointed to the FOMC minutes that came out on Wednesday afternoon, called them balanced but a little stale, and added this looking ahead to Jackson Hole and Chairman Powell. Powell should sound less balanced at Jackson Hole, since the latest data rise the risk of a fresh increase in inflation. Chairman Powell in Jackson Hole, 10:05 Eastern Time, a week today. Let's stick with the earnings. Applied Materials issuing a bullish forecast, signaling the chip slump may be easing. The CEO said this: over the past several years, we've focused our strategy and investments on key technologies to accelerate the AI era, enabling us to consistently deliver strong results in 2023. That stock is up by about 1% this morning. Let's turn to the utility sector. Shares of Hawaiian Electric rebounding after providing an investor update in an SEC filing, saying the company's goal isn't to restructure. Joining us now to discuss, Bloomberg's Simone Foxman. Hey, Simone.
Hey, John. Yeah, if the gains that we're seeing this morning hold, this would snap an 8-day losing streak where the stock lost almost 68% of its value. But this investor update appearing to give traders a little bit of positivity here. The company also saying that it intends to be there for the long term. It's also restored power to about 80% of affected customers. However, 1,900 people, it says, still without power in Maui. Something else that may be driving the stock this morning, Bloomberg reporting late last night that Jefferies is among the bond brokers that has been sending out quotes for private placement notes at deeply distressed levels, 40 to 60 cents on the dollar. But this could be a signal that the company is really moving forward with trying to grapple with the kinds of losses it faces as a result of these Maui wildfires. Of course, plenty left unknown, and of course the PG&E many bankruptcy examples, still lives large. Moody's also cutting as the rating of Hawaiian Electric to junk last night.
That stock up by almost 12%, about five minutes into the session. Just to double check the clock there for you, 5 minutes into the session. This move this morning following 8 straight days of heavy declines for the stock. Wells Fargo stepping in, saying they've seen enough, upgrading shares of Hawaiian Electric to equal weight and writing the following: with a depressed valuation, we think the risk reward is far more balanced in what is a highly volatile situation. We believe these are scenarios, albeit seemingly remote, where significant upside exists. That stock is up by 9.6%. Let's turn back to the earnings. Estee Lauder delivering a weak outlook, signaling a slower than anticipated recovery in its Asian travel retail business. The CEO saying this: we're taking actions in Asia to capture demand from the returning individual travelers and continuing to reduce inventories as we navigate the current market headwinds. Katie has the story. Morning, Katie.
Good morning, John. Yeah, Estee Lauder taking a beating on the heels of that report, currently off about 5% from the bell after delivering that disappointing outlook. Let's get into the numbers first, because the fourth quarter adjusted EPS actually came in at 7 cents versus estimates of a loss, while revenue beat expectations as well. But the company warned that fiscal 2024 adjusted earnings will be $3.43 to $3.70 a share. That is below the consensus estimates. And Estee Lauder, it also said that net sales will decrease by 10 to 12% in the current quarter from a year earlier. So those are the numbers. Let's get into the why, because the beauty company had said that ongoing weakness in its duty-free business in particular in Asia, that is expected to overshadow the sales growth that it sees in markets such as Europe. And specifically, Estee Lauder said that too much inventory after misjudging demand from travelers in both China and South Korea this year is going to weigh on the bottom line. It's the duty-free business, primarily in Asia, that makes up about a third of Estee Lauder's revenue. So that's weighing on guidance. That's weighing on the stock this morning. For the year, Estee Lauder down almost 40%.
They've not had a good time of it at all. Katie, thank you. That stock is down by another 4.9%. The concern there, as Katie indicated, on Asia, potentially on China, much more so in the months still to come. I want to turn back to Bank of America and some of the numbers they've put out recently, just in terms of the global economy and not just the US economy. This is what they've got to say this morning. Global data is gradually confirming our view that the main economic blocks are likely in the process of decoupling. The title of this research, the decoupling continues, but can it last? They point out, as we all know, the US remains strong, China continues disappointing at the margin, and global investors are becoming increasingly concerned. They say this going forward: it is likely this decoupling continues, or the negative impact of a China slowdown impacts the US outlook. I guess pick your poison, but that's going to be a debate for us, not just the domestic economy in Jackson Hole next week in our coverage when we're down there in Wyoming, but also on the global economy. Can we decouple, or will that China slowdown actually start to weaken the rest of the world? About 7 minutes into the session, just a snapshot of the price action for you. We are negative by 0.5% off the lows on the NASDAQ. We're down by 0.9%. Into the bond market, 6 days. It's been relentless over the last month, but the last 6 days particularly, 6 consecutive days of yields higher on a 10-year. The 10-year this morning down about a basis point to 427. Let's turn to the earnings. A host of retailers topping earnings estimates this week, but delivering a warning to investors about the outlook. Walmart's CEO saying this: rising energy prices, resuming student loan payments, higher borrowing costs, tightening lending standards, and a drawdown in excess savings mean that household budgets are still under pressure. Got a similar message from Target, stating the consumer is still taking a very cautious approach to discretionary spending. Student loan payments will cause additional pressure on already strained consumer budgets. State Street's Laurie Heinel joins us now to wrap this up and look ahead. Laurie, great to catch up with you as always. This year, I said it this morning, it's been like the economist who cried recession, and now it's the retailers telling us this is truly it. The consumer's going to hit some headwinds. Do you think they will?
Well, we don't think the consumers are hitting too many headwinds yet. Certainly they're spending on savings. Certainly they're pivoting their expenses from goods to services, and so that's part of what you're seeing in the retailers. But as long as employment markets remain strong, which they continue to do so, we think that the consumer still has legs.
You and I have talked about the prospect for a soft landing. Is there such thing as too much of a good thing? Is this data too hot?
Well, it is too hot through the lens of what does the Fed then do? One of the big conundrums is that the inflationary pressures just are not coming down as fast or as durably as what we had hoped earlier this year. And so that's going to keep the Fed kind of on watch. We actually think they've done enough already, but as long as some of this data comes in strong, and especially as we see third quarter GDP being strong and we see inflation pressures not really abating, the Fed might feel compelled to do some more work.
And Chairman Powell, according to Bank of America, should sound less balanced at Jackson Hole since the latest data raised the risk of a fresh increase in inflation. Is that what you think is going to be the driving force behind that speech a week today?
We do. And look, the trajectory on lowering inflation is not going to be a straight line. There are likely to be bumps in the road. We're going to lose the benefit of some of the base effects that we saw earlier in this year. And so we're likely to see episodes where inflation starts to become a little bit higher again. Again, we believe that the Fed has done enough already, but given the fact that they were late to the game, it's likely that the Fed will remain more hawkish than perhaps is ideal.
Only 2 weeks ago, we were talking about being in a soft spot, in a sweet spot for a soft landing, Laurie. Has anything changed in terms of your outlook for the equity market?
Well, we still think that there's a trajectory here, and in fact, we think a hard recession is really not likely at all. And every month that we go by where the employment picture remains strong, inflation starts to look like it's starting to abate, central bankers maybe are getting to the end of their tightening cycle, that gives us confidence that we could actually see, if anything, a very minor type of recession in 2024, but even perhaps a soft landing. So we do still have hope, and we remain constructive on risk assets more generally, but certainly it's a very precarious world out there right now.
You have retained one hedge, and it's gold, Laurie. Why is gold the hedge of choice for you?
Well, look, gold is one of those few things that actually provides diversification against this backdrop. As we see, when equity markets are selling off, we're seeing bond markets sell off at the same time. And so you want something in the portfolio that's going to react very idiosyncratically to the rest of the portfolio. So gold is one of the few places where you can find that.
Laurie, do you think that's the risk, that we get a repeat of last year for 60-40 investors, that your bond allocation and equity allocation can fall simultaneously given what's developing?
Well, we don't think we're going to have a repeat of last year, and in part that's because the starting point is a lot better. So if you think about bond yields with a 4 handle, that provides a lot of protection. You're getting some nice income there. If you look at adding credit to that, the credit spread has been pretty durable. So we don't think we see a repeat, but certainly we could be entering a period where you have very muted returns across the board.
It's felt like it this week, that's for sure. Laurie, thank you. Laurie Heinold there of State Street on the latest. About 12 minutes into the session, just an update for you on the equity market. We are negative by 0.5% on the S&P, a fourth day of losses potentially on the S&P. There's a lot still to play for the rest of today. On the Nasdaq, we're down by 0.9%. In the bond market, yields have been higher all week, every single day this week. We're backtracking just a touch by not even a basis point on a 10-year. 427 right now on a 10-year. In the FX market, some dollar strength out there for you. The euro now just about holding on to 108, 108.58, and negative 0.1% on that currency pair. Coming up on this program, the former president taking Fed Chair Jay Powell to task.
I'm not a fan of Jay Powell. I would not reappoint him. I thought he was always late, whether it was good or bad, but he was always late. I was surprised he was reappointed.
We'll catch up with AMH down in Washington up next.
I'm not a fan of Jay Powell. I would not reappoint him. I thought he was always late, whether it was good or bad, but he was always late. I was surprised he was reappointed. I was very tough on him, and if I wasn't, I think we would have had much higher interest rates for much longer.
Presidential candidate Donald Trump speaking with Larry Kudlow on Fox Business yesterday, taking a shot at the Federal Reserve Chair Jay Powell. This ahead of next week's Republican presidential debate in Milwaukee. The president, the former president, still hasn't said whether or not he'll show up to the event, saying, quote, "If you're leading by a lot, what's the purpose of doing it?" I guess that's a question we've got to go ask going into next week. One man who will be on that debate stage is Governor DeSantis of Florida. And this is what he has to say on Chairman Powell. "We need to rein in the Federal Reserve. It's not designed or supposed to be an economic central planner." He's gone on to say it is not supposed to be indulging in social justice or social engineering. It's got one job, maintaining stable prices. And it has departed from that with what it's done over the last many years. Joining us now, I'm pleased to say, Bloomberg's Anne-Marie. AMH, the former president, not the only one taking shots at the current Federal Reserve Chair. What do you think that actually looks like in practice if one of those individuals is in the White House?
Well, it's a great question because, of course, Powell has a term till 2026. So if one of those individuals was to go to the White House, do they fire him? Remember, Trump in 2019 said he should be able to demote or fire Jay Powell. And then one of his most brazen critiques of the Fed chair at that time said he didn't know who was worse for the U.S. economy, Jay Powell or Xi Jinping. So this duel and drama between Jay Powell and the former president is not new. You'd have to be living under a rock if you didn't know how Donald Trump felt about Jay Powell. But it does bode this question that other candidates are going to have to answer. How do they feel about how the Fed has handled the economy? It's been a difficult few years for the Fed, obviously coming out of COVID-19 and this handling of inflation and now the rate hikes, the path of the aggressive rate hikes we are on. So DeSantis is in the Trump camp. The governor is saying a hard no, he would not reappoint him. But then there's others like Governor Chris Christie, who sat down with us and said he doesn't think Jay Powell did anything horribly wrong. He would consider it. Obviously, he thought he was a bit late on inflation. But then we spoke to Doug Burgum yesterday, Jonathan. This is the governor of North Dakota. He is running on an economy-first campaign, but he would not speculate about any future appointments, but he doesn't like the way the Biden administration handled inflation.
Let's talk about next week. If you're leading by a lot, what's the purpose of doing it? The former president's words about attending the debate next Wednesday. What are the arguments for and against for his team attending that debate?
Well, I think if the president was to show up, he would take the oxygen out of the room, and potentially he has a chance to lead even further in the polls. He's also an individual that probably doesn't want to be left out and wants to dominate. And the only way to do that is to show up and dominate alongside those other individuals on the debate stage. But at the same time, given the fact that he does have this wide lead in the polls, he's thinking, do I even need to go there? And there's a CNN report that they're leaning towards not showing up, but they, of course, at the same time saying we could change our minds at the 11th hour, and potentially he just does his own counter-programming. And then Republican primary voters will have to flip-flop between the two if they want to see an array of different voices on a stage or just want to hear what the former president has to say.
Let's get those names on the screen again and go through them. Anne-Marie, give us the guide for next week. From your perspective, the names to watch, outside of the obvious, Governor DeSantis of Florida, who would you be looking for?
Well, I'm really interested to see how Senator Tim Scott plays this, because he's putting millions of dollars at the moment following this debate in ad campaigns, and he sees potentially a way that he can have an uptick in the polls following the debate. Also, Vivek Ramaswamy, this is an individual that we know from troves of documents from a super PAC that is helping and advising Governor DeSantis. They're saying that he should hit Vivek very hard and defend Donald Trump. So it'll be interesting to see how Mr. Ramaswamy deals with that, especially as his numbers have really been rising in the polls.
MH, thank you. An update down in Washington. It's good to have Anne-Marie back. Anne-Marie Hordern there in Washington, D.C., our chief Washington correspondent. About 21 minutes into the session, equities are negative here by 0.3% on the S&P. On the Nasdaq, we are lower by 0.7. Into the bond market, Treasury shaping up as follows, with yields lower by about 3 basis points on a 10-year, 4.24 on a 30-year here, down by about 2 basis points to 437 with some sector price action. Here's Abby.
So we are off the lows for the S&P 500 to your point, John, down just 0.3%. Moments ago, we had actually more sectors higher than not. And we could actually, and we do actually right now in this moment too, as industrial flip-flops between very small gains and losses. Up top, though, consumer staples, a bit defensive, up just 0.4%. To the downside, though, communication services, one of those mega cap tech sectors, down 1.3%. Tech down 0.8%, and discretionary down 0.5%. So those mega cap tech sectors getting beaten down once again today. Now on the week, so many different superlatives, as you know. The worst 4 days since March, the worst week, I believe, since February. These are the worst sectors. All 11 sectors are lower. Discretionary up top. I think Tesla has a lot to do with that, down 4.2%. It'll be interesting to see if and when that stock, not if, when that stock gets a break. And then real estate, this is interesting because maybe in sympathy with China, or it could just be the fact that yields are higher and those dividends look worse, John.
Abby, thanks for the update. What a week we've got coming up for you next week. Think about what's on the horizon, on the agenda, on the earnings front. Nvidia, just explosive gains through the year so far in 2023. On the political front, we've got that debate in Milwaukee, the first one for Republicans coming up on Wednesday. That, by the way, hosted by Fox News. And then on the macro front, who knows what's going to happen with China? But one thing we do know, we're going to hear from Chairman Powell, scheduled to speak next Friday in Jackson Hole, Wyoming at 10:05 Eastern Time. About 23 minutes in, equities lower, your trading diary up next.
He has a range of choices. He can talk about short-term monetary prospects, he can talk about longer-term monetary prospects, or he can punt both and focus on some of the challenging economic issues facing the U.S. economy. But what he says is going to be critical in terms of what it does to the bond market.
This hour, moments ago, Mohammed Al-Arian on the bond market, on Chairman Powell going into Jackson Hole next week. The price action trying to recover from 3 days of losses. Will it become 4? Let's see if this sticks. Let's get to the trading diary. The week ahead looks like this. President Biden heading to Hawaii on Monday to assess the damage in Maui. More retail earnings Tuesday with results from Macy's and Lowe's. Then the first Republican debate taking place on Wednesday in Milwaukee. The earnings event of the week. Nvidia reports after the close later next week. Jackson Hole kicking off on Thursday with Chairman Powell speaking on Friday. From New York City, that does it for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day and enjoy your weekend. This was the countdown to the open. This is Bloomberg.
At that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, August 18th. Here are the top market stories that we're following for you at this hour. A 5% world. Bank of America warns that yields could return to pre-great financial crisis levels. And the combo of higher yields and a weakening yuan could shave 4% off from the S&P. And a bad week for tech. The Nasdaq 100 falls 3%. Worst streak of weekly losses since December. We look ahead to Nvidia out with earnings next week. And far-fetched is, well, far-fetched. Shares plummet after cutting its full-year outlook on weak U.S. luxury demand. China wobbles and execution risk. See, guys, I told you I stopped spending. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And let's overlay one more thing here, and that's options expiration. You got a bunch of options expiring, which is going to lead to some volatility. Maybe you have to see some covering from the dealers, and that could exacerbate the moves as we head into the close also.
Absolutely. What a week it has been. And next week is Jackson Hole, and we've got a whole load of other factors we need to throw in as well. Nvidia's coming out next week. This week's been amazing, hasn't it? You take a look back and see what's happened, this incredible move that we've seen in the bond market. Alex, European equities have been absolutely battered this week on a similar path to what we've seen in the Nasdaq. There's been some significant pressure. The question is, how big is this adjustment going to be? How far through it are we? If we're in a 5% world, how long is it going to take to adjust to that? We've had many years of zero interest rates and QE and all of that stuff.
That the fact that we're just talking about 5% really means we should eventually be talking about 6%? Like, I mean, I feel like just the fact that we start talking, it's like you got to look forward, and then we're looking at 6%, and how long it stays something like that?
I hear what you're saying, but I don't think the difference between 5% and 6% is as significant as 0 and 5%. And that's the real difference here. Everybody thought that we were going back down to a world that we had before the pandemic, but maybe actually we're going down to a world that was before the GFC, and that's the mind shift that needs to take place here.
I mean, yes, exactly. And then how you have to reallocate and think of that. But I also wonder, too, how can we be there? We sort of price in Fed cuts? Like, do we need to price that in or price it out? And kind of what that, or is that not the right question to be even thinking about right now, I guess?
Anyway, the question I'm thinking about is Estee Lauder. Does skincare really matter?
Invest in your face. That was the takeaway from yesterday's show, Guy. Invest in your face. Maybe you don't need the high end.
Not my face, everybody's face. Anyway, our question of the day, let's take it back to the beginning, not the invest in your face question. Are we in a 5% world? Let's try and answer that question. Liz McCormick joins us, Kriti Gupta joins us. Liz, are we in a 5% world?
Well, I think we are, and actually Alex stole my thoughts that I was going to say, you know, with all this 5% brewing, and we've seen the 2-year at 5, the funds rate is well over 5, you know, that we, you know, talking about 6, and you're hearing more people say that, maybe in the long end. Now, I'm not saying the Fed necessarily, but I think that's like, if we get used to like a 5% may be the base for a while, then why can't long end rates get higher to 6? You're seeing more people say that. And, you know, Larry Summers said 10-year could average, I think it's 4 3/4 over a decade. So that means a little bit of time over that, and a little bit of time under that. So I think, yeah, we've got to brace ourselves. If things continue as they are, that these rates could keep going higher.
Yeah. Kriti, what do you think? 5% world or even higher now?
Well, okay, I'm going to take the contrarian take here. I think we have hit the 5% world. I think we might be in it for the temporary future, but I don't think it's going to last. And I think the reason for that is because I think when you're looking at the pre-GFC world, it's not the same kind of circumstances, and a big part of that question is China. And the reason I bring it up is simply because if you look at the read-through from China 15 years ago, it's not the same as it is right now, to the point that a lot of this is going to kind of filter through the commodity sector, then through the bond sector. It's a domino effect that I just don't think is going to last.
Okay, let me throw another angle on that, Kriti. Why have yields backed up as much as they have this week? Because it doesn't feel like an inflation story. It feels like there are other forces now at play as well, which could have longer, stickier effects. This is about deficits and shifts in the labor market, and go back to government spending as a big factor as well. But there's a whole range of other factors which now seem potentially are in the mix to keep yields higher for longer.
Well, I mean, you said it right there. The idea that it's becoming more of a, I think, again, I keep saying this, a plumbing issue because there are so many other factors. You just brought it up. The fiscal deficit issue, the kind of holdings of treasuries from around the world that is truly declining from some of the major players, Japan, China, Saudi Arabia. You're seeing it across the world, whereas the bigger case for inflation driving yields, which as you just pointed out, again, came down to commodities. If you looked at it in the last even 2 or 3 years when you saw this massive rise, followed by, of course, the Fed policy as well, it was because commodities were rising so fast. You can make the same argument for the early 2000s. Is that going to sustain? I'm not convinced.
Well, and this, Liz, let's get to the plumbing for a second. And maybe I'm thinking too far out. But if China keeps having to defend the yuan, like they're not going to buy treasuries and they have to sell it. And I'm just wondering in terms of the plumbing, how much is that going into what we've seen in yields over the last week? And even the Bank of Japan, right? Like even what's happened over in Japan, like how much of that is filtering through?
Yeah, and I love Preeti, but I'm going to say, yeah, the plumbing matters. You might call it technicals and all this other whatever, but it's really mattering more. So yeah, you have that risk of these foreign accounts who haven't been big buyers in recent years anyway, been whittling down, maybe selling more, and all these forces like. I think what's pivotal here is we usually have rising government deficits, more government spending, et cetera, when we're in a downturn, when the economy is slowing.
Yep.
But the economy is not, and they're plowing forward. You know, you speak to our folks in Washington, they say the Democrats want to spend more, Republicans want to cut taxes. You know, that's not going to change, and that's, I think, why people are really concerned. You know, Ed Yardeni was on TV this morning saying the same thing. You know, maybe finally people are worrying about that, you know, you have all this debt coming and a Fed where maybe inflation's going to come down, maybe China weakening will help, but I don't get any sense that the Fed anytime soon feels like they're not going to declare victory next week. They have a long way to go before they're clear that inflation's going to get to 2% and stay there.
So essentially, we've got more supply and fewer buyers, which isn't a particularly good combination. Kriti, if that is the case, let's just for the sake of argument assume that we are in a 5% world. How much more adjustment do you think other assets have got to make to get back to a world where 5% is the normal?
You're not going to let me go until I say it's a 5% world, are you? Look, I think...
Leading the witness.
Clearly. I think when it comes to, tech stocks, which a lot of people have looked at in terms of sensitivity to the yield space, I don't think you're going to see that much of a difference, but I think you do have a catch-up for some of these other sectors, simply because if you look at, say, the winners or of the latest equity rally, yes, we know it's tech-heavy, but the losers of the 2022 rally were, again, your big tech players, and they took a bigger hit. Of course, Paul, have that as weightings, but they did take a proportionally bigger hit than some of their other sectoral counterparts. And I think you're kind of missing that in some of the other sectors. Take a look at financials, for example. The loan growth has not reflected that world of sustainable 5% yields. I could make the same argument for industrials as well. A lot of even airlines, I would argue, that are borrowing and need that extra cash, I don't think they're ready for a 5% world in the long run.
Yeah, I guess it depends on when it cracks, though.
Your guess is as good as mine.
Right, but it feels like that's the point, is that we can get to, maybe we're living in a 5% world, we haven't adjusted to a 5% world, but then as we adjust, do we get to a 6% world? Do you know, is that
like
how
a domino effect.
Exactly.
Yeah, I could absolutely see that, and I think the way you're going to kind of gauge that in at least real time, as close as you are, because I think at the end of the day, this is something that can really only be determined in retrospect, but as close as you're going to get to that it's happening is how this issuance from a lot of these companies is actually received. And so far, they're actually digesting pretty well, which is why I think maybe we are used to a 5% world, but get to a 6% and that marginal increase, as small as it may be, that Guy pointed out at the top of the show, I think it's going to get a little bit harder to get buyers for that kind of debt.
Right.
Absolutely, and that's a really good point. Liz, is a 5% world good for the bond market? Is this something that you should buy the bond market on the back of, or is actually the compensation still not there? In a 5% world, where do rates really need to be to attract investors, to make them feel like they're comfortable and they're getting compensated correctly?
Well, there is a camp of investors, like someone said this morning, they're like on vacation for now, but that really like, buying these bonds. They, these long-term investors have said, we haven't seen these rates in a long time. So you are seeing a good amount of people, especially asset managers, who say, hey, listen, we want to snap up 30 years, 20 years, 10 years.
But Liz, that argument is we haven't seen it for a long time, i.e. we haven't seen it during the period between sort of now and the GFC, but does that mean that it's still a good trade?
Right, but that's what I was going to warn, that there's people wanting to buy, but it doesn't mean that rates can't go higher. And, you know, not to say I'm old, but I mean, the truth is rates have been a lot higher. We're just not used to it. So I'm not screaming, you know, 10%, you know, yields, but I think we have to realize that, you know, like in that Bank of America Investment Institute report where they say we're in a 5% world, they're saying things are changing, you know. First of all, their economists got rid of the recession call, right? So slow growth, Fed above 4%, a little bit sticky inflation. It's kind of stagflationary, debt building, certain demographics, deglobalization, all leads to, and we don't have to be screaming higher in yields. We can just be hovering at these higher yields for longer, which I don't think a lot of people, some people expected that, you know, for sure the Fed's going to be cutting soon, you know, we're going to see the 10-year back to the 2 handles. That just seems further off. So I'm not screaming, you know, mayhem and chaos, but I just think there is an argument that rates could stay sticky for a while.
I kind of got Critty to say 6%, so let's just keep that in mind. I mean, it did, like in the future, kind of. All right, guys, thanks a lot. Really appreciate it, Liz and Critty. Great to get your perspective on this Friday. Good way to kick us off. All right, coming up, more on our question of the day. Are we in a 5% world, and what do you do with that? We're going to break it down with Kim Forrest of Wk Capital Partners. She does like certain areas of tech. This is Bloomberg.
Next week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
All right, time now for our question of the day. Are we in a 5% world? And then what is the impact of that? Guy, I just want to point out here, I'm looking at the NASDAQ 100 down by 0.8%. A really bad week for the NASDAQ 100. And you also have things like Meta yesterday breaking below its 50-day. Apple was already below some of its moving averages, but now you have Meta rolling over as well. Now, Google holding up, but you just wonder what kind of follow-through selling we're going to wind up seeing.
In theory, this should be really bad for long-duration assets. In theory, this should be really bad for tech. I think you need to differentiate tech, though, and think about kind of the smaller companies without the cash flow versus the big guys that have the cash flow? Because these companies are hugely cash generative.
Yeah.
And you would have thought that companies that could generate cash at this point, that cash is worth more because you're discounting it to 5%, aren't you?
Yeah, well, but also maybe you just already have priced in the good stuff. Like you just run too far too fast. So look at Deere, for example. Yep. Like you just kind of peaked out on that. So Kim Forrest, Wk Capital Partners founder and CIO, joins us now. Kim, you like tech. Where in tech do you like? And should there be a correlation with long-term yields?
Well, there's always a correlation with long-term yields, but it's over what time period. I hate to go all full nerd on you right from the beginning of this segment, but you know, the last couple of days, the bond market has overreacted, right? Like it moved unbelievably high, unbelievably fast, given the good news about the growth in the U.S. economy. So everybody's spun up about, oh my God, the Fed's going to, have to increase rates. And so the whole bond complex moved up. Now, the stocks are overreacting as well, because do we really believe that this is the world we're going to live in? I don't think so. I think we're going to settle to somewhere under 4%, which would then make the prior world of a month ago look pretty good with some of the tech stocks. So I would not throw things out. This is just generally what happens in August, where there's not a whole lot of people on the bond desk or on the stock desk. So the markets overreact at this time. So that's where we are.
Okay, Kim, for the sake of argument, say we are in a 5% world. Say the risk is that we're potentially in a 6% world. Right. How different does that narrative look?
It's a grossly different narrative, because then I believe that the Fed is trying to really stop the economy and throw it in reverse. So let's say we're going along at 40 miles an hour because the economy's good, but it isn't great, right? So that's 40 miles an hour. Yep. But then we have 6% 10-year. That would be
why? Okay, sorry.
So
Kim, why are you assuming that this is the Fed? So what seems to have happened this week, certainly judging by the people that I've been speaking to, is that actually this isn't about inflation. This isn't about what the Fed's ultimately going to do. This is about the Bank of Japan not wanting to be a big buyer of treasuries, potentially China being a seller of treasuries. This is about big deficits and government needing to spend. And all of those factors basically mean that the bond market has fewer buyers and a lot more supply that it's got to deal with. And that's the adjustment that we're seeing right now. This isn't about the Fed. This isn't about inflation. This is a longer-term narrative that's beginning to develop.
Right. Well, I think I've always been a proponent that the U.S., the EU, and probably somewhat Japan, but it's a relatively small nation. They are maybe the marginal buyer of our debt. But certainly China, we all have to have proportional interest rates. And that is what was happening last year, is the U.S. was the leader in ramping up the interest rates, and it left the EU and certainly China behind. China has its own issues, but it is a big buyer of bonds, so we have to pay attention to that, and that's why I don't think we get to 6%. Sorry.
Okay. If we don't get to 6%, no need to be sorry. It's totally fine. You can have that opinion. If we get to sub 4, like you're saying, what are you buying right now?
What am I buying? I'm looking at the crazy stuff, which I think will give the other host an eye roll. I like
always has eye rolls. It's fine.
And I like consumer discretionary. Oh my. There's a couple of places that I do like, and I think, again, if you're holding this for 3 to 5 years, tech is an especially good area to go hunting right now.
Discretionaries. There's a great story on the Bloomberg terminal at the moment about what's happening at the University of Alabama, which I think is amazing. And if you think the discretionary is toast, then read that story on your Bloomberg. Kim, how does discretionary stand up against mortgage rates that are at 7%, student loans that are going to kick in, all of these factors that the headwinds for the consumer seem to be growing rather than receding?
Sure. Well, the consumer isn't one big glob, right? There are different segments of the consumer, and we tend to like companies that focus on the higher, we'll say, quartile of the socioeconomic scale. So if you look there, these are people that probably have the bandwidth to, if they want a new house, they can buy a new house, but they probably are well settled in the house, so that's not an argument. And their student loans, these are high earners. Again, they will have some issue because of student loans, but it's not going to be, do I buy that sweater or do I pay my mortgage? That's not the group we're going after.
Kim, I would never roll my eyes. Never in a million years.
Just
Not
to me,
when certainly
just to
talking
me.
to you. With Alex, oh yeah, definitely.
All the time.
Without a shadow of a doubt. With you, never. Far too polite. Far too polite. And I think what you've got to say is really interesting. I think the whole story around whether or not bonds stick at 5 or 6, I think is still very much questionable. Kim Forrest, enjoy your weekend. Wk Capital Partners founder and CIO. Alex, I would definitely roll my eyes at.
I mean, how many times have you done it this morning?
On a pretty regular basis. Okay. Let's talk about what's happening at Palo Alto Networks. Investors wondering why the company's reporting results on a Friday afternoon, or whether they should be worried. We're going to find out pretty soon. Caroline Hyde's going to join us. This is Bloomberg.
It is 22 past 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Caroline Hyde. Now, Caroline, usually like on Friday afternoon, you wouldn't expect some tech earnings to come out, right? But Palo Alto is. What's up with that?
What's up with that is the pressure that you're seeing on the stock since they announced it back on August the 2nd. The stock has tanked about 20% because everyone's worried that they're going to announce something that the market doesn't like in terms of forward-looking guidance. They give us a full year view for their full year 2024. We get the encapsulation of what 2023 has looked like. And when you're doing that on Friday, when the market then closes for a couple of days, when you're used to giving us earnings on a Monday or a Tuesday, everyone's like, what is up with that? Wedbush is saying everyone's preparing for the worst. And look, this is a company that's likely to give us about 18% growth, but that is not what we're used to. And certainly when a competitor like Fortinet then on August the 3rd came out with earnings that the market didn't like either, it's just been down, down, down. I think this is going to be a big PR headache if what the PRs have told us so far is that it's just a logistical issue. If it turns out to be something else, Guy.
Has the market now priced in enough bad news? So I'm kind of The market will then go, okay, there's going to be bad news, we'll price that in. Have we already done that? I.e., is the actual option here to the upside rather than the downside?
Well, certainly the price targets are to the upside by about 20%, and you're also seeing 40 buys on the stock and not a single sell. However, a lot of analysts are saying they're all the inbound calls, or whether this has already been priced in with that 20% sell-off. What's happening at Palo Alto Networks is they've been a beneficiary of certain clients in this macro environment saying, I want to consolidate my security provider, therefore I will buy for everything from one-stop shop. That's now curtailing, and when you've got the likes of Microsoft coming out with new opportunities, the competition is rife and people are having to think about how long people want to sign up to new contracts for. That seems to have been an issue at Fortinet, so we'll have to see how they weather this macro environment.
Talk about macro environment for a second. We may get an ARM IPO listing next week, and Instacart potentially also in the wings, right? So are these idiosyncratic things, or is the market kind of opening again, which is striking considering the sell-off that we've seen?
Totally wild time, given that we've seen for the first back-to-back losses in the NASDAQ, I think it's in the, NASDAQ 100 for the entire year, and suddenly we start to get this drip feed. The market perhaps is ready. They've understood what ARM is offering. Of course, semiconductors has been pretty hot, particularly if you're thinking about the new world of AI. $8 to $10 billion valuation we're expecting, and also this is probably a SoftBank view of when they want to be making the most on the money. But we are anticipating a filing coming next week. Will we get the detail of how big and how much and a price? Probably not. You have to wait for the drip feed of that. But Instacart, we understand, is also going to be filing next week. And overall, the context is we've had, $14 billion worth of IPOs this year compared to 240 or there and thereabouts back in 2021. The market, I'm sure, will take some of this down. But remember, the valuation guide for Instacart used to be at almost $40 billion, and now it's at like $13 billion in the last private round.
Kara, are people talking about NVIDIA next week as being an event?
Oh, yeah. Everyone's going to want to know what's going to be happening with that particular chip maker. Again, like whether the valuation is substantiated, whether or not AI is becoming part of the overall earnings theme, because you are starting to hear that. Just think about the pop we got in Cisco yesterday, because they actually articulated we got $500 million worth of sales through artificial intelligence. NVIDIA has been really the one-stop shop on how you bet on AI and real revenue.
Caroline, looking forward to the show. You've got a busy week next week. It's going to be great. Caroline Hyde, you can catch Caroline on Bloomberg Technology. It's in around 90 minutes' time. Coming up, investors say far-fetched is, well, far-fetched. This is Bloomberg.
And we're about an hour into this trading session on this Friday. It's been quite a week. Yields taking a break, but the sell-off continues. We also have options expiring as well. Abigail's tracking all these moves for us. Abby?
Yeah, the declines continue here, Alex. We now have the S&P 500 and the NASDAQ 100 near session lows, down a fourth day in a row, the worst 4 days, I believe, since the beginning of March. On the week, some real weakness, too, not surprisingly. We'll be taking a look at that in a moment. But to Alex's point, take a look at this. We have yields down, that 10-year yield down 4 basis points now at a 4.23. That should be providing relief for investors, although on the other hand, it's true risk off. You have bonds rallying and stocks down, crude oil down a little bit, so that's risk off also. That is a risk asset. Investors not buying it up. But I will say it is back above, staying above WTI crude above $80 per barrel. So a bit of a risk off tone today. To Alex's point, it's really what we've been seeing all week. This is the week that has been, and as you can see, down 2.64% right now, near session lows on the week. And this is the worst week since either the end of February or the beginning of March. Another way of saying that is in many, many months. So we've had this big rally this year, but over the last couple of weeks, not so much. Well, what is one of the drivers beyond yields higher? Well, it's what we've been talking about for many weeks as well, and that is, of course, the dollar. Now, this is some chart. Take a look at this roller coaster ride for the dollar. What I would say, though, is we are breaking this downtrend here on this big move higher on the year, down 0.5%. But over the last, I think, 3 to 4 weeks, Alex, 4 weeks, up 3 to 4%. That's a huge move for the dollar to make in such a short period of time. No wonder risk assets are getting a bit roiled.
All right, great stuff. Abigail, thanks a lot. Really appreciate that. Challenging results also for some consumer retail stocks today. You got shares of beauty company Estee Lauder and online luxury retailer Farfetch are tumbling. So let me just explain Farfetch for everybody here. It's basically a luxury online retailer. They're also buying Richemont's stake in Yoox Net-a-Porter, which is exactly what it sounds. A lot of sales on luxury stuff. I want to bring in a Bloomberg TV reporter, Simone Foxman. They're similar and they're different. There's some execution issues with Farfetch for sure, but what did we learn? What's the macro read from these two guys today?
Both flagging weakness in the U.S. consumer and a very slow Asian consumer to come back. And that really playing into both of what we're seeing. Both of them cutting annual outlook. Estee Lauder has been cutting for a long time. Farfetch had a much better earnings last quarter. And part of this may be not just the execution risk, but also that, you know, there were high expectations seeing this luxury as a port in the storm. We knew about Estee Lauder's problems. We knew that it was struggling to adapt to an Asian consumer that's a much larger part of its business. So perhaps that's a little bit more baked in than what's happening with Farfetch.
Can you just talk to me about the execution issues? What are they? You listen to the European luxury companies, they talk about a slowdown in the US, but it's not that dramatic.
Yeah, I think these are, frankly, the slowdown that both of these companies were talking about seems much larger and frankly mirrors some of what we've heard from the likes of all the retailers in the United States, whether it's Target, whether it's Walmart, talking about how the aspirational consumer, particularly that, you know, middle class or lower middle class that has been trying to spend more and has been spending more throughout the pandemic, really seeming to be struggling, and that is a key consumer for both of these brands. You know, Estee Lauder's execution risks, though, really dealing with Asia. Asia is now about a third of its, Asia travel retail is about a third of its business, and it just has not been adjusting to that problem so well, and we're continuing to see that this quarter for sure.
Okay, I just also want to point out that then there's a story. Second read story on the Bloomberg right now. Students are spending 20 grand on Rolex and Cartier for Bama Rush. So this is basically, colleges are back, there's Rush, which is you're trying to get into sorority, and it's gotten really competitive in certain schools. Parents are hiring consultants to get their daughters in, for example, which I've read as well. And this is basically, a banker went on TikTok, looked at these videos, guy, and then priced out what people were wearing. And you could pay as much as $20,000. Now, who knows where they bought these things or if they're going to return it after, but that to me does not say a slowing consumer.
These children are dressed very differently than I was at university, which basically involved rugby top, sports top, and a pair of DMs, which I pretty much had for the entire university experience. This is crazy. I don't understand the sorority thing. That's something that we don't have over here in the same way by any stretch of the imagination. The numbers are unbelievable, but I guess if you believe that this is important, maybe you do. I honestly, I don't understand the sorority thing. I'm glad you explained what far-fetched was because I'd never heard of it. So yeah, I'm not sure that I'm the right person to be talking about any of this.
No, you're not. But I'll explain one more time. Like, we can throw shade at the 20 grand that you're spending on your outfits for sororities, but this goes back to the Farfetch story. Did you buy it on Farfetch or Ukes, or did you buy it at a Porte? Like, are you buying it at the discount on the retail level? Are you renting it? Or are you buying it from Real? We talked to the president earlier this week. Or are you going to resell it? So it's like, it's not as easy as the headline
You've really
sounds.
thought about this, haven't you? You've really thought about this. Okay.
Am I more excited talking about this or Contango?
If you could combine the two, I think it would be amazing. But yeah, the whole rental thing, that's amazing to me, that basically you could rent it. I get the discount stuff, but you can buy some of this stuff on discount. But in theory, I would have thought whoever's pricing this would take that into account. That would say, I'm getting too logical about this, that you can buy this stuff on discount. The rental thing, maybe that's possible. But again, this is insane. And the competitive nature of US universities, we've seen huge court cases around all of this in terms of getting kids into the right schools, but now getting into the right sorority, and you have to have all this gear to get amazing. Who says there's not excess still in the world? Because if that's not an example of excess still in the system, I don't know what is.
Yes. Simone wants in, but then Kate's telling us we have to go, so I think we have to go.
Okay, well, just quickly, but maybe these Bama students are not the aspirational consumer. Maybe their parents are paying for it.
Oh gosh, I hope so.
Oh yeah.
I mean, if I'm 18 and can get a 20,000 Cartier, like, rock on.
I think Contango would be a great name for a luxury brand. I'm sure somebody out there needs to name a brand Contango. Alex Steele, this is a whole new career, potentially. This is your label, Contango. Anyway,
by
Simone,
Steele.
Great stuff. Thank you.
You guys together, you should do it.
There you go.
I'd buy it.
It will be amazing. I'll be your fashion advisor. What we got coming up next? Believe you me, that would be a bad idea. Coming up next, we're going to talk about, this is a subject I'm much more comfortable with, large trucks. Gas-powered large trucks. Gas as in the gas-powered large trucks. We're going to talk about it next. This is Bloomberg.
On the ETF World, 1 p.m. New York time, 6 p.m. in London. This is Bloomberg. It's time now for ETF Friday. Katie Greifeld has been taking a deep dive into the EV world of ETFs. Katie, what are the flows like right now, particularly as tech sells off?
Well, as always, there is an ETF for that. So right now we're looking at DRIV. This is the Global X Autonomous and Electric Vehicles ETF. It's the largest EV-related ETF. And I wanted to look at performance because it's been pretty interesting. It's still up 19% on a year-to-date basis. But you look at the left-hand side of that chart, you can see it's pretty much a straight line down 14% in the month of August alone. So definitely some of the euphoria has cooled. Let's zoom out, though. Let's look at the 5-year chart because we had started to see some of that enthusiasm come back since the end of 2022. Of course, that has fizzled now, and of course, we are well far away from the halcyon days of 2021, but still up over 63% on a 5-year basis. That is outperforming the S&P 500, but a bit below the NASDAQ 100, some of your big tech names. Let's look at the holdings of this fund because I think it's really interesting. It's an EV fund, but as you can see, we have a lot of just tech stocks in there. We have a lot of the chip makers, and of course, we have the likes of Tesla as well, and some traditional automakers in the likes of Toyota. But you add that all together, these are exactly the names that have been getting slammed recently, and that goes a long way to explaining why some of the euphoria has come out of names such as Drive.
Great stuff. Katie, super appreciate it. Thank you so much. So let's stick with EVs for a moment and talk about EV trucks. So Hyliion makes renewable natural gas trucks. So it captures emissions from landfills and dairy farms, and it puts it in natural gas pipelines to power up its engines. Now the stock did close at a 52-week high yesterday. Let's get more on this. Thomas Healy, Hyliion founder and CEO, joins us now. There's a couple things to break down, but I want to start with the trucks. You're currently in fleet trials. Give us a sense of how close you are to scaled up production.
Yeah, so when we went public back in 2020, it was really our kickoff to go commercialize this powertrain solution. We've been doing that for the last few years here, and we are just months away now from actually beginning deliveries to fleets in the start of production. So what that means is we're now just starting fleet trials. We'll be doing that here in the next couple of weeks, where we're taking our assets that we've been testing for years now and actually putting them into the hands of fleets so that they get to experience it in their operations. So we're really right at the about to launch this product and get it out into commercial deployment here. So it's an exciting time at Hyliion.
Let's talk. So these look like really big trucks, Thomas. How far do they go? What kind of range are we talking about? What kind of infrastructure needs to exist around them to get this into service operation story really to work?
So you're hitting all the normal problems that electric vehicles have, right? Charging problems, or is there available grid electricity? Well, our vehicle, it is a big Class 8 semi-truck. This thing hauls 80,000 pounds of total vehicle weight. Normally, an electric truck only gets about 100, maybe 200 miles of range. Our truck, though, we use a onboard generator to charge the batteries as the vehicle's driving. So we actually get 1,000 miles range. So now this operates much more like a diesel truck. You're not range limited, and we can use existing natural gas refueling infrastructure to recharge this truck.
So, Thomas, a lot has changed since I last spoke to you on my commodity show. Many things, in that there's been a lot more money pumped in for the green transition. There's also been an anti-woke, anti-green pushback, and there's also been a Federal Reserve raising rates by 500 basis points. And I'm curious as to how all of that affects the interest. Do what your customers want change frequently now?
It has, right? It's evolved. I think a couple of years ago, fleets were talking about anything electric they were going to adopt. Now they're looking at it and saying, we really need to make sure this makes economic sense for our fleet if we're going to adopt this. It needs to be better than a diesel truck, or you need to bring us a ton of benefits. And so we're able to do that with this vehicle, and really because we're leveraging renewable natural gas or natural gas to fuel it, that's a really cheap fuel. It's about $1 to $1.50 a gallon. So we can give them that economic benefit. But what we've also seen happen in the trucking industry is just overall prices have gone up. Vehicle costs have nearly doubled from where we were a couple of years ago. So pricing is getting a lot more.
Freight rates have come down quite a lot, though. Has that changed the economics? We're starting to see big trucking companies going out of business. That's going to put more supply of existing vehicles back into the used market. Is that going to change the economics? Just talk to me about as the trucking industry evolves post-pandemic, what the supply-demand story looks like. Are people still buying new trucks right now? Do they want new trucks right now?
So there still is actually, surprisingly, a supply shortage of new trucks. Mm-hmm. That is changing, though, right? Fleets are holding the assets longer. Some fleets are going to buy used trucks as opposed to brand new. So we're seeing that all impact this space. I think probably the area that's been most impacted is, that by now the thought was there would be many, many thousands of electric trucks out on the road. Mm-hmm. And we're still at a point where it's just hundreds of trucks out there. But fleets are still expressing interest in electrification. It's just a longer ramp up to what was initially expected.
How much do you think that is to do with the demand or the supply? I mean, with rates where they are, you might still want them, but having to finance to buy them is a whole different story. How is that affecting the demand base?
Yeah, that is impacting it because fleets are basically saying we're not going to take the increased cost burden onto our balance sheet. We need the end customer to take it on. And it's still a question mark as to if the end shipper is going to want to pay the extra amount. Some companies that have a very strong ESG initiative, they are willing to pay more. Others that more just want the lowest cost solution, they're not. But that is one of the areas where ours is very differentiated than a conventional plug-in or hydrogen fuel cell vehicle, where in about 3 years, this can have a positive ROI or payback for the fleet compared to a diesel truck, actually.
How many of these trucks are financed? I'm assuming most of them are. And does the economics change at yields where they are right now? We've gone from a zero interest rate world to a 5% interest rate world. What does the trucking industry, what does your business look like in a 5% world?
So most fleets want to finance their vehicles. That's pretty conventional. They want to do the same thing with electric trucks as well. And obviously, as you pointed out, that then adds a lot of cost to the overall solution. So that's where I think, going back to the points earlier, we are seeing a slower ramp up of electrification, but the interest is still there. Mm-hmm. And that's where we've really grounded in. We need to make sure this makes economic sense. And the only way to do that is to use a low cost source of electricity or power, which for us is going to be natural gas. The grid is more than diesel in many instances, and then hydrogen's much more.
So, Thomas, talk to me about then how the financing affects your business. On your last earnings call, you said you'd have enough cash to get you through 2024, and then after, if the market conditions were right, you could maybe issue new shares. If we have rates stay at 5%, does that change your calculus, how you can ramp up and how you can perform?
Yeah, so if you look at most of our competitors in the space, everyone is out trying to raise capital right now. They're almost out of capital, or within a year they'll be out. For Hyliion, we expressed we could get through the end of 24, even into 25 without needing to raise. So it kind of puts us in a position where we can be opportunistic about when we do raise. So we think we have some big milestones coming up, start of production of this solution. We also will start stationary deployments of our Carno generator technology, which is a stationary power solution. So we can actually power a building like this off of that generator. That all will happen next year as well. We think those will be good catalysts to then look to actually be able to pull in more capital into the company, to continue development.
Which one of those two things do you think is going to end up making you more money? At the moment, we have power shortages, grid shortages. You look at what's happening in Hawaii right now. You look at what is happening in California. Do you think actually the future of your business is in trucks, or do you think it actually could be in fixed power as you're now getting into?
Yeah, so we're in trucking right now. Next year, trucking is a very big focus, but as you're pointing out, stationary actually is a bigger addressable market, right? And so if we can use the same generator in the truck that we do, we could also use for stationary power, then that gives us two total addressable markets that are both very large. Stationary, we think, can be very differentiated, though. Our generator, we acquired this technology out of GE about a year ago, and it's fuel agnostic, so it can run on over 20 fuels, very low maintenance, low cost of operation. So for instance, in many states, we'd be able to produce electricity at your facility for cheaper than you could buy it from the grid.
That's quite an impressive proposition. Thomas, it seems like the business is evolving fairly quickly. Don't be a stranger. Come back. Keep us updated on what is happening here. Thomas Healy of Hyliion. Thank you very much indeed.
Thanks for having me on.
Okay, coming up. The $1.5 trillion private credit market just set a fresh record for the largest loan that we've ever seen. We're going to dive into the details. That's next. This is Bloomberg.
Time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance. And today we're going to take a look at private credit loans. They are growing bigger and bigger, breaking records. Joining us now, Bloomberg's Shanali Bastick. All right, what you got? What are you looking at?
We're looking at the clearing of some significant hung debt in the system here.
Finally.
Finally. And, really, if you think about what's going to happen in the second part of this year, when people come back from Labor Day, there's some deals in the pipeline that are either already there where it's going to be an interesting story about how they're financed, or there are going to be new deals that we may see come back. Now, those deals would include Cineo and WorldPay, but remember, we also saw a record deal here when you look at Finastra, and the idea that more than $5 billion of a package was put together here by private lenders. Very importantly, one of those lenders was Blue Owl. A couple of months ago, I had a conversation with the co-president of Blue Owl. This is a $5.5 billion deal almost. He was telling me that in the next couple of years, you could see a deal package of $10 billion being put together by these private lenders. At that time, again, it was a couple months ago, he told me that over a 12-month span, he has gotten at least 60 views of more than $1 billion deals. And if you think $5 billion is big or rare, imagine a $10 billion deal just a couple years down the road.
Wow.
Blue Owl. Cool name. Tedesio, let's talk about what's happening there. The LBO debt, they finally get it to market, and then the secondary market doesn't look very clever. Does that tell me about still how ultimately fragile this process is?
It does, because remember, selling at a discount never feels good for the banks. The interesting part about this particular deal, according to our colleagues over on the leverage finance desk, it's incredible. They were able to make enough interest here to really make up for some of the losses that the banks would have borne otherwise. Now, remember, there are other kind of implicit costs here. This cost, for example, tied to not doing other deals in that time frame. Yes, it's good that the losses were really contained. It does clear up some capacity to do one moving forward. I got to say, there's
there's some massive things. One thing to look at, I think, is Cotiviti, for example. That was another $5.5 billion nearly deal in the private credit space as well. That kind of died earlier this year because they couldn't get the deal done. Do those sorts of things come back because enough capacity has been cleared up? The point you're making also, Guy, there's another thing under the surface here, and you do see this issue when it comes to the leveraged loan market where defaults are rising. So it's not even just that this debt is being sold and syndicated in a way that is less than ideal, even if they are making up for the interest. You're also watching kind of the market see issues when it comes to the actual quality of the loans themselves and the reasons they are being used. But you still don't have enough capacity here. Leveraged loan volumes, new underwriting has fallen off by 30% or so, more than any other type of underwriting. So the fact that there's no capacity kind of saves you a little bit here because there is not enough new deal movement here to get people to stay away from the market should the market come back to life.
It's getting better, but not it's not all the way. It seems to be the narrative. Shonali, really lovely work this week. Thank you very much indeed. Busy week. Another one upcoming, I suspect, for Shonali. European markets, Antian has not bounced today. That's the takeaway from today's session. It's down by another 2.68% today. It has not bounced after being battered yesterday. It's interesting, we talked to the company, Bloomberg talked to the company, they're not looking at buybacks. I think they're saying that basically they feel that the faith has been shaken a little bit. German 10 years catching a bid, we're down by 10 basis points today. Are we still in a 5% world? Germany probably isn't, but Italy could be. Stock 600 down by 0.7% today. It's down by around 2.6 this week. Roland Carolan, Soc Gen's European equity strategist, joining us in the next hour. We have a lot to talk about. That's next. This is Bloomberg.
Experts, great questions.
18th of August, European stocks are down on the day, definitely down on the week. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
$447 is now where we are, so we're below 450 on the stock 600. We continue to fall. We're down by around 2.6% on the week. We're certainly moving away from that 260 level. Is this fundamental? Has something changed? Is this just August? Are there other forces at play? I don't know. I think we're not going to know the answers to all of these questions in reality until we come back in September and everybody's back. We're past the holidays. And then we get a clear idea of what's really going on. There's a number of positioning factors that are worth bearing in mind. Weak retail sales out of the UK today. Apparently it's rain related, which, believe you me, doesn't surprise me in the slightest. You've certainly not been buying summer gear here in the UK this August or the month before, or actually the month before that wasn't too bad. But the pound certainly suffering a little bit, not by much, on the back of that. And then the story of the week, Ajahn. Down by 2.6% again today, this after being absolutely battered yesterday. I think it's significant, Alex, that the stock has not bounced.
It really is. We're going to get to that later on. The co-CEO talking to Bloomberg earlier. All right, here, you take a look at the S&P and the NASDAQ 100. It doesn't look like a lot, but it's a cumulative effect. For example, the NASDAQ 100 is looking at now 3 straight weeks of losses. We haven't seen that kind of weekly loss since December of 2022, having been down now about 3% on the week. Plus, you get Meta below its 50-day. Those kind of things wind up picking up steam to the downside. You're also having some hedge funds overall in the stock market. They seem to be reloading on their shorts. We also have a ton of options expiring today as well, so that could lead to significant pressure if there's more put buyers out there. If you're a market maker, then you're going to have to sell shares in order to sell that put, and that could potentially create more pressure as well throughout the day. Okay, other assets. One, dollar yuan. This is the offshore cross. I say this because this has been the topic for me over the last 4 days. What is China going to do overnight or over the weekend to have to support its currency? The overall Bloomberg Dollar Index is now above its 200-day moving average. That's not good news for the PBOC. Bitcoin also getting slammed. The why is kind of funny. There was a headline that potentially SpaceX has sold off its Bitcoin holdings, and that kind of weighed on sentiment. But nonetheless, there's a little shakeout happening there, Guy.
Absolutely. You can maybe correlate it back to what else is happening more broadly in the market, but it's been interesting how long Bitcoin has been stable, which is very unlike Bitcoin. Bitcoin normally a lot of volatility. Now we get the volatility back. Alex, I want to talk about what we've been addressing really over the last hour or so, which is, are we in a 5% world? This obviously is a pivot off the Bank of America note. But I want to apply it now to maybe a more European perspective. When we think about, are we going into a 5% world, we're really talking about the United States. But let's extrapolate that into what's happening here in Europe. Now, Germany doesn't feel like it's going into a 5% world, but maybe Italy is, and maybe the periphery in Europe is. The numbers always amuse me and how similar they are between the Italian 10-year and the US 10-year. Italy currently yields 4.3, the US currently yields 4.2. They're not too dissimilar. So if the US is going into a 5% world, is Italy going into a 5% world? And if Italy's going into a 5% world, is that a world that Italy is going to do well in? And I think this is going to be an interesting question that the Europeans need to address now. Italy has done much better than a lot of people had anticipated because while it has a lot of government debt, it doesn't have a lot of private debt. What does a 5% world do to Italy? What does a 5% world do to the periphery, Alex?
Yeah, I've done nothing good. I'm just going to go out there and say that. And if we're talking about 5%, I'm making a point, then we're talking about 6% eventually. So earlier, Bloomberg Television spoke with Mark Hafele, UBS Global Wealth CIO, and got his take on whether he sees 5%.
Because the inflation expectations in the United States remain anchored, we're not yet in the 5% camp. We're approaching the peak in some of these rate hike cycles. And so we still think it's a good time to lock in yield here. And also, on the more investment grade side, on the credit side as well.
Mark Hafele joining us a little bit earlier on. Our question of the day is a fairly straightforward one. Are we in a 5% world? Justina Lee, Noor Al-Ali joining us now on set to discuss. I saw Noor a little bit earlier on. I haven't seen Justina yet. And I asked you this question and you just went, yep. I'm going to need a little bit more.
Yeah, absolutely. Well, we were pressed for time back then, but now we've got all the time in the world, right? Because
don't tell the producer that, but yeah, no, I agree.
Absolutely, right? Because, Guy, I mean, when we're talking about 5%, I think the question is how far do we go from here, right? Short-term yields, particularly, it's a story about the Fed policy rate, too, and if we're looking at the neutral policy rate, there was some research out from the Fed, New Yorker Fed research earlier, a couple of weeks ago, that talked about that policy rate really being much higher than the Fed's projected, and that really does show you that potentially those monetary policy tightening efforts have not really fed through to the economy as we've seen, so it means the Fed has more work to do, and those yields will only have to push higher.
Okay, so if we're at 5% level here in the U.S. in the 10-year, Justino, are we looking at 5% for Italy? What does it mean for Germany?
Yeah, I think that really is the question here. Now, in Europe, as we have seen in the U.S., I mean, we have seen kind of inflation pressures abating a little bit. But at the same time, I mean, Europe started tightening monetary policy later as well. So that's not really changing expectations for the ECB to hike again this fall. But I think more broadly, the question is, you know, I mean, inflation pressure maybe are abating because economic growth is slowing. And, you know, European growth is usually more cyclical. It's more tied to, you know, the rest of the world. And given what we're seeing in China, I mean, does that mean that maybe Europe will see demand and growth slow more than we previously expected?
I'd say the bigger question that I'm trying to figure out this week is, not the bigger question, but a question I'm trying to figure out this week is, are rates going higher because of inflation concerns, because of growth concerns, whatever it is that's happening, or is this just a simple supply-demand balance story that we're watching in the market? There are going to be fewer sellers. There are going to be fewer buyers. There is going to be much more supply coming through from governments in the United States. It's fascinating that Italy's just trying to push through a bank tax that didn't go very well. France is talking about taxing toll roads more. Everybody's trying to raise money at the moment because governments are going to be stretched going forward. They're going to have to issue more debt. And that ultimately probably means that yields are going to be hard on a kind of supply-demand story.
Right. I mean, that's the message that we're hearing from the Treasury, right? And if we kind of break down U.S. yields, the break-even rate, which is sort of the market indicator of inflation expectations, actually haven't moved up that much, but it's actually the real yields that have moved up. Mm-hmm. So I think one kind of more positive interpretation is that, you know, people's expectations of long-term economic growth have gone up, and maybe that's part of it. But the other part could be the supply picture, as you talked about as well.
So that's a more structural kind of situation, Nor, particularly as we're going to see more money being pumped in for, say, the green transition, etc. So, sake of argument, if we're at 5%, what gets beaten up the most? What's the biggest reallocation?
Yeah, I mean, that's an excellent question that you and Guy talk about, because we're not just talking about treasuries upping their demand, upping their supply here because of that structural demand, especially for the need for more debt or for more borrowing to fund these climate-related needs that they have. But there's also the question that's coming across from Asia. Now, let's take a look at treasuries here, and if we look at the proportion of the foreign holders, you'll see that Japan and China are the biggest holders or foreign holders of U.S. treasuries. They make up 26%. I looked at the numbers data earlier with Valerie Teitel, and then it's a whopping number. And when we're talking about interventions, Guy, coming across with their currencies, that means those banks in China that are being asked to kind of sell the USD to buy the yuan. There's a lot of talk about interventions out of Japan as well, and for them to support the yen. What's going to be sold in the market? And that's going to be the treasuries. Yeah,
it may be treasuries. It may also be some of the euro-denominated bonds as well. Can Italy survive in a 5% world? I've been through various European crises, and it doesn't feel like we're there yet, but I'm wondering how long, if you have a growth rate down here and you have an interest rate up here, Italy can sustain that for, Greece can sustain that for, various of the peripheral countries can sustain that for.
That's an excellent question, Guy. And the fact that you're asking it means a lot of the people in the market are thinking about it as well. How far across are we from a debt crisis? The economy in Italy at the beginning of 2023 was pretty good, you know. We're not, I mean, if we look at research from Bloomberg Economics, they're not really expecting that anymore. You are seeing that impact, that monetary policy lag really being felt out of Italy. And that's why the government is coming there and saying, well, where can we get a
we need to raise some money here.
Exactly, 100%. And they're trying to almost, get a step ahead of what's going to happen in the economy. And I'm pretty concerned here about what's going to happen when it comes to their debt to GDP ratio and whether or not we've got a debt crisis brewing at our hands.
Well, yes. And also I have to wonder, too, A debt crisis would be a whole different situation, Justina. But even without a debt crisis, the rising yields, what that means for European equities, because the biggest bull is going to say, oh, European equities are really cheap. Yet we continue to see 20-plus weeks of outflows now for European equities, Justina.
I know, I always feel like we've heard about European equities being cheap for like 10 years now, and it never really had like sustained inflows. And I think the question here is, I mean, European stocks are generally, you know, value equities, and value equities should do well when bond yields are going up. But I think a lot of the time the precondition for that is that economic growth has to be picking up as well. I mean, the other way of kind of asking that question is like, you know, are bond yields rising for the right reason? And a lot of the time the answer is no. And of course, kind of if we look at the U.S. side of things, I mean, you know, U.S. equities have really benefited from these big, you know, structural tech trends. You know, we're talking about like AI here, for instance, and those names don't tend to be in the European market.
No, fair enough. Maybe payments, but then you have ATM. All right, guys, thanks a lot. Really appreciate it. Also appreciate you guys sticking around on a Friday. Justina Lee and Nora Ali, thank you so much. All right, still to come, more on our question of the day. Are we in a 5% world? And then what do you do with that from an equity perspective? Roland Caillois is SocGen's European equity strategist, and he's going to join us next. This is Bloomberg.
I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles.
The Fed's record is perfect. They always get it wrong. GMO co-founder Jeremy Grantham speaking to David Rubenstein. You want to watch the full interview, and I really recommend it. You're going to see it on Bloomberg Wealth, on Bloomberg Television. It's going to be coming up in September. I've seen a little bit more than that. Jeremy, as ever, worth paying attention to. It takes us back to our question of the day. Are we now in a 5% world, and how do we adjust from a zero world with lots of QE to a 5% world with lots of QT? How long is that process going to last? The first thing we've got to figure out is, are we in a 5% world? Is this the new narrative that we've got to deal with? Roland Caillois, SocGen's European equity strategist, joining us now. Roland, as ever, fantastic to see you. Are we in a 5% world? What does that mean for European equities?
Hi. I'm not sure we are yet in a 5% world, to be honest, when I'm looking at German bond yield, when I'm looking at US Treasury. But if the question is what will be the impact on the European equity and what will be the impact for risky assets, clearly I can see much more downside from the current level.
How quickly would we need to re-rate to get there?
I mean, to get there, it's, and you had a very interesting discussion before. I mean, together, it's what's going to be the driver, you know, to bring a yield at 5%. It's going to be inflation driven. It's going to be growth driven. Clearly, it seems that we are more on a question of inflation, central bank's reaction, and this is going to not be very positive for European equities.
Just in terms of the scale of the not very positive, like how much further could we have to fall from here?
Look, we are already at this, current level. We have already a very stretched risk premium. So it means that investors are ready to accept a very low reward to carry equities compared to what you can get on fixed income. I'm not talking only about what you can get on a long-term bond yield. Look, the risk-free rate is very, very high now. Short-term, you have also a very high yield offer in the credit market. So when you compare equities to all this fixed income yield you can get from this product, clearly the market is back to level we haven't seen for decades relative to fixed income.
So where do you hide out in that? Because Europe doesn't have a ton of tech, those high growth tech companies as the US does. So clearly you don't want to be owning that, but you don't want to own Europe as well. So what am I doing?
Yeah, the thing is that in the market, in the European market, you got big dislocation when you look at the valuation, right? European equity market looks super cheap. We are trading on aggregate level at 12 times. But this is because you have very few sectors that are trading with deep value, and it are pulling the overall index, the overall market PE ratio. So those sectors are energy, automobile sector, financial sector, which are trading with PE ratio around 6. If you remove this sector, the market is not trading at 12. You are not adding 1, 2, or 3 points of PE. You are adding 4. So it's 16, in fact, when you are removing those sectors, those very deep value sectors. So to answer your question, yes, we have some growth type of sector, luxury goods, some technology sector, which are trading with very, very high PE ratio.
If China is a real problem, and we don't know yet, if it really cracks, what's the read across into Europe?
What, sorry?
What if China has a big problem? If we see the Chinese economy slowing down significantly and the data we've seen thus far get worse, what does that mean for European equities?
Oh, let's remind what happened this year. If we rewind a bit, at the start of the year, what has been one of the driver of this fantastic bull run for the European equity was China, right, with the reopening story, etc. And if you ask me if things are clearly worsening in China and what would be the impact, it could be very, very negative for European equities. So what has been very a support and a tailwind for European equities at the beginning of the year, starting to be the opposite now, and this is clearly something we are monitoring now.
Why haven't we seen all of this sort of play out? Like, I appreciate the European equities have tried to trade soft. Euro stocks is below the 200-day moving average. We've seen more outflows in Europe than the U.S. Like, I get that. But, like, why haven't we seen the really big shakeout, I would have thought, from the China data that keeps coming out overnight and from these yields that are pretty sticky?
So because you have some positive also on European equities, when you look at the hard data, they are quite good. When you look at the recent reporting season, it's not a great one, but it has been, somehow reassuring investors. And I will say that there is something very important to have in mind, and that's the reason we don't expect, even if we are heading in a recession in the US or this kind of type of scenario for next year, we think that, the contraction around 10% will be, quite fair, and why not 30 or 40%? Because European corporates are cash rich, and we don't have the kind of leverage used to have before a recession. So this is, I think, also a big difference right now between the coming recession and the one we have seen in the past.
Roland, is that this cash story that keeps coming up time and time again? The companies that have cash are being seen as more valuable in a world where they can get 5% on that cash. How important is it that treasurers, that CFOs run their businesses in a way that generates more cash? They free up more working capital. They figure out how to generate more cash so that that cash can generate a return and make their free cash flow numbers look even better. Is that a strategy right now?
Well, clearly, companies are taking advantage of this. I mean, if you look at the credit market and how much company could borrow money on the market, it's much lower than what cash could reward from now on. So this is very important. As I say, also, it's I think a position from management because let's be clear, we had the COVID, then we had the war, then now this year we talk about recession risk. I mean, that's clearly not an incentive for any manager to take big risk. And this is something we can see if you look at investment capex to sales ratio, it's very low. If you look at M&A, it's pretty low also. So you can really see that management of corporates are really on the defensive, and they prefer to keep cash on the balance sheet.
All right, Roland, hey, thanks a lot. We really appreciate it. Roland Cayuin, SocGen European Equity Strategist, thank you for joining us. Coming up, Adyen rules out a share buyback following a market meltdown. Details on our conversation with the co-CEO next. This is Bloomberg.
Let's get back to the big story, the big corporate story out of Europe this week. Adrian, the co-CEO of the company, is ruling out a share buyback. So Bloomberg News has had a conversation with the management team, who I imagine are quite shell-shocked. This comes, of course, after the results, which were bad, but maybe not that bad, triggered the massive meltdown that we saw yesterday in the Dutch payment processing company's stock. It was absolutely brutal. Take a listen.
It's clear that we lost some trust yesterday. And I think the best approach to this is now very carefully listening to our investors and see how we can get back some of that trust.
Henry Wren joins us now on set. The team's been talking, you weren't part of the kind of conversation with the management team, but the sense of shock must be profound.
Yes, definitely. When you judge from the share price reactions, 39% drop yesterday and another 3% today. So wiping out $20 billion of market value. So it's definitely a shock. The shock comes from the growth side. Remember, the company never failed its medium-term growth target of mid-20s.